And joining me to break down what we have seen in the market scene today is Richard Court from Argon Asset Management. Richard, thanks so much for your time this afternoon. It is day 3 of that market sell-off, really a bloodbath out there. We are seeing a bit of a turnaround when it comes to local markets, but the picture in Europe really sour. Talk to me about how you're positioning yourself amid the turmoil, especially as we know that volatility is likely to remain as we are under Trump's administration.
Yes, good afternoon, and thanks very much for having me on. Just very interesting question. Someone very wise said to me this morning that your risk management takes place when you are buying the shares in a company, not when the bad news hits. So when the last couple of days, I think, has been a fantastic example of that. So what we have been trying to do here is we've just been sticking to our knitting. We focus on trying to buy solid businesses with proactive and responsible managers with solid balance sheets at low prices. So we're going to carry on doing that. We don't have a crystal ball. We don't think anyone else has a crystal ball either. So we can't say with 100% certainty what we think is going to happen in the near future or distant future. But we do think if we own a diversified portfolio of businesses with those characteristics, we think that we will be okay in the long run. And I think our clients will be okay in the long run too.
And how concerned are you about the tit for tat we are seeing? We saw China hit back last week. There are reports that the EU could possibly hit back this week. How concerned are you that this could now become a fully fledged global trade war?
Yeah, so tariffs in themselves, they don't really protect anyone from anything. They just protect consumers from low prices, which I'm saying that tongue in cheek is not a good thing. And it's a barrier to free trade. And we want, I think, as a citizen of the world, the freer the trade, the better for global growth. So no, a tit for tat situation with the EU and China raising tariffs on the US is not ideal. Far from it. A far better outcome would be what we're seeing from places like Vietnam and Argentina, where they are engaging with the United States to have zero tariffs. But I think if the outcome of all of this is a world where we have far less tariffs and far freer trade, I think we'll all be better off for it. But as I say, so yes, it is concerning. How do you navigate it is also very complicated. As I say, we're going to stick to our knitting. It has served us well in the past, and we expect it to serve us well in the future too.
It's really interesting to see how Trump has been playing this tariff card. On one side, we are seeing some nations hitting back. On the other side, as you mentioned, there are some nations negotiating. And with that, I want to bring in the TikTok story. We've seen Trump delay that deadline yet again. Does this leave room to negotiate with China, perhaps?
Look, I mean, I must admit, I've never met the man. So I cannot claim to be an expert in how he thinks or how he deliberates. But my sense is that he does want to strike a deal, and he wants to strike a deal in person. So maybe it is part of a bargaining tool. But I must admit, I'm not terribly close to the TikTok story. I'm not a user of TikTok. So it's difficult for me to say, but I do. He does seem to want to realign trade flows globally, and that might be a part of it.
And with the tariff story, we've seen fears around a global recession being reignited. And now markets are pricing in about 4 to 5 rate cuts. Are we getting ahead of ourselves here? Or, is this this dovish stance needed at this point?
So, look, I mean, I think the price of oil is also indicative of that. I mean, the price of oil has fallen considerably. I think West Texas was, I think, below $65 earlier this morning. So trade investors seem to be pricing in a recession. And yes, and now all of a sudden the expectations around Fed cuts has increased, as you've mentioned. The thing with the Fed and trying to front run the Fed seems to become a bit of a sport at the moment. but they've got a dual mandate where they need to manage price inflation and they need to manage US unemployment. So if a lot of individuals seem to think that these tariff wars are going to lead to inflation, but if this attempt by the US administration to onshore some manufacturing capacity, and if it leads to US unemployment not deteriorating significantly, and there is inflation, it's very hard for the Fed to cut rates.
Yeah.
And if they do, it is simply going to be a Fed put where it's trying to bolster the US equity markets. Now, I want to be very careful about making a macroeconomic forecast. I did find the US Treasury Secretary's statements around the breakdown of who actually owns US equities quite insightful as to possibly his thinking around trying to prop up equity markets. He seemed to imply that it's only like the top 10% of US households are actually exposed to US equity markets, and the bottom half of US households are just exposed to debt, and therefore it's more interest rates that are more important. So again, I'm not going to make a forecast about it. But yeah, we live in very interesting times.
Yeah, be interesting to hear or rather see what those Fed minutes have to say. I think they're out on Wednesday this week. Richard, let's just hit pause on the conversation. Before we get to your pick, let's reflect on some counters that have found favor with your industry peers.
It's Bidcorp, which, as you know, is basically the European food supply business. The problem in the global markets at the moment is supply chains. If you're a company that depends on a global supply chain, you've got a problem. Bidvest is not in that position because they are, what they sell is what gets manufactured in Europe, and I can't really see a trade war between European countries in itself. So they are protected from the turmoil of global trade problems. I think they are sitting at a decent valuation. I think Europe as a continent, as a whole, it probably has better growth prospects than a lot of other areas globally. So it's a company that's specifically in that geographic environment, decent valuation, and less risky than a lot of other big companies that you can go for offshore.
We are going for something closer to home for our stock pick. So Super Group, I think the key attraction there, I mentioned it earlier, is that essentially 60% of the market cap is cash in terms of the proceeds that they're going to get from the disposal of SG Fleet. And that is imminent, and so you're left with the balance of the business, which is more South African-focused supply chain operations. So I guess in the short term may be impacted somewhat, but as you've seen that most commodities are excluded from tariff, so those are less impacted. Demand may drop, but I think again, very low expectations in the what's left of the business, so you're getting it extremely cheap. It's going to be de-geared, and I think it looks like a very attractive prospect at these levels.
So Rowan going with Super Group and Rickers picking Bidcorp. Your analysis on those counters, Richard?
Yeah, so starting with Bidcorp, actually I agree with lots of what Rick has said about the company. We also hold it in very high regard. I think it's a very good business with a very capable management team. We saw they were able to demonstrate in 2021 and 2022 with all the lockdowns, the COVID-related lockdowns, how disrupted supply chains got. They actually were able to demonstrate that due to their organizational structure and culture, that they were able to navigate that better than their peers. And they were also able to show that they could pass on inflationary costs quite adequately. So they did very well operationally during that period of time. So I would share that opinion that it's a good business, and they're probably well placed to navigate whatever's coming down the pipeline with tariffs. I also agree with his statement around it being a decent price. It's not. We were maybe a bit greedier. We've got. This is not a indictment of management of the business. It's just we think that other people have a far higher regard than we do for the business. So we would probably just wait a little bit, hopefully get it at a lower price. Then it comes to Super Group. It's another company that we've had a history with. As Rowan said, it is pregnant, as they say, with a dividend. So that is expected and factored in by the market. We share the point that the rump of the business, the leftover parts of the business, is not being rated very highly by the market. But we have some concerns about those businesses. There's been some changes over the last few years. There's some business that has that supergroup subsidiaries have lost that doesn't appear to be coming back. So for us, it does look cheap, but we're not sure it is cheap enough. So we're actually not holders of Supergroup at this point in time. We will reassess it once the dividend has been paid out, because by selling at these higher prices, we've effectively got that dividend already. And we will take a look at it after the dividend has been paid, and see what the market reaction is to a very different looking supergroup, and also a lot smaller in terms of market capitalization. There might be some weaker hands who might not be able to hold which will essentially be a small cap business.
So a wait and see approach when it comes to Supergroup. But what are you holding right now? What are you nibbling on? What's your stock pick?
Stock pick, and it's something that we've held for a while now, and has done very well for us of late, has been British American Tobacco. It's been one of our largest positions for a while now, and it's starting to pay off a bit. It is trading at about an 8% dividend yield. A year ago, it was over a 10% dividend yield, so the share price has increased over the last year. Some of the concerns that the market has had is that British American Tobacco would not have been able to increase its prices to offset the volume demands. Volume declines as people smoke less. What the market, we also think, has completely overlooked the new generation products, which is a growth vector for the company. And we just think it is trading so cheaply. It's a very consistent dividend payer. That dividend is stable. They are de-gearing the business, and they are buying back shares. And we think the market is overlooking the growth of the new generation products. And that's why it is one of our top holdings.
Richard, thanks so much for your time and taking us through markets action at midday. That was Richard Court from Argon Asset Management.